I'm May, and this is May Retires. Most people think Social Security is tax-free. It isn't. And the way it becomes taxable is one of the strangest, most counterintuitive mechanisms anywhere in the tax code. Economists actually have a name for it: the Social Security tax torpedo. It's called that because as your other retirement income rises through a specific range, your effective tax rate can spike dramatically, then drop back down, like a torpedo curve on a chart. And pre-retirees who claim early, at 62, without understanding this mechanism, often walk directly into the steepest part of that curve. Here's the trap. Up to 85% of your Social Security benefit can become taxable. Not 85% of the excess, 85% of your entire benefit, once your other income crosses certain thresholds. And those thresholds, like the net investment income tax thresholds we've covered before, have not been meaningfully adjusted for inflation in decades. Today, I'm going to show you exactly how this torpedo works, the specific income thresholds that trigger it, a real example of the effective tax rate spike, and the strategies that can help you manage around it. The taxability of your Social Security benefit is based on something called provisional income, not your total income, but a specific calculation. Provisional income equals your adjusted gross income, plus any tax-exempt interest, plus 50% of your Social Security benefit itself. The thresholds: single filers, $25,000 to $34,000, up to 50% of benefits taxable; above $34,000, up to 85% taxable; married filing jointly, $32,000 to $44,000, up to 50% of benefits taxable; above $44,000, up to 85% taxable. These numbers have been fixed since 1984 for the lower threshold and 1993 for the upper threshold. Unlike almost every other tax bracket in the code, they've never been indexed for inflation. What used to only affect higher earners now affects the majority of retirees with any meaningful pension, part-time income, or investment income alongside Social Security. Here's the mechanism that makes this so punishing. As your other income rises through the threshold range, you're not just paying tax on that additional income, you're simultaneously making more of your Social Security benefit taxable. This creates a stacking effect where your effective marginal tax rate on that last dollar of income can spike to 22.2%, 40.7%, or even higher in certain combinations, well above your nominal tax bracket, before dropping back down once you're past the point where 85% of your benefit is already fully taxable. Claiming Social Security at 62 instead of waiting until full retirement age or 70 means you're receiving a permanently reduced benefit for the rest of your life, up to 30% less than your full retirement age benefit. But the torpedo connection is this: if you claim early while still working part-time, or while drawing from other taxable income sources, you compound two problems simultaneously. You've locked in a smaller benefit, and depending on your other income, up to 85% of that smaller benefit may also be taxable, on top of the earnings test penalty we'll cover in a separate video. A married couple, both 62, decide to claim Social Security immediately upon eligibility. Combined, they receive $42,000 a year in benefits. They also have $30,000 in pension income and $15,000 in dividend income from a taxable brokerage account. Their provisional income calculation: $30,000 pension plus $15,000 dividends plus 50% of their $42,000 Social Security benefit, $21,000, equals $66,000 in provisional income. That's well above the $44,000 upper threshold for married filers. Result: 85% of their Social Security benefit, $35,700, is included as taxable income. Combined with their pension and dividends, their total taxable income is substantially higher than they anticipated. and they find themselves in a higher marginal bracket than they expected when they were planning around just their pension and Social Security. Move 1. Model your provisional income before you claim, not after. Before deciding when to claim Social Security, calculate your provisional income under different claiming ages and different combinations of other income. This lets you see, in advance, whether claiming early pushes you into torpedo territory versus waiting. Move 2. Manage the timing of other taxable income around your claiming decision. If you have flexibility over when to realize capital gains, take IRA distributions, or draw from a pension, coordinating that timing with your Social Security claiming decision can keep your provisional income below the thresholds in the years that matter most. Move 3. Use Roth accounts and tax-free income sources strategically. Distributions from a Roth IRA do not count toward provisional income because they're already tax-free. Pre-retirees who've built up Roth balances specifically for this purpose have a lever to pull. Drawing from Roth accounts instead of traditional accounts in years when they're close to a torpedo threshold can keep their Social Security benefit from becoming taxable. Common mistakes people make trying to avoid this. Mistake 1. Claiming at 62 purely based on getting money as soon as possible without modeling the tax impact of combining that benefit with other income sources. Mistake 2. Not realizing that tax-exempt municipal bond interest still counts toward provisional income, even though it's exempt from regular income tax. Mistake 3. Assuming the torpedo only affects wealthy retirees, the thresholds are low enough that a modest pension plus Social Security alone can trigger it. Here's your action item this week. Before you claim Social Security, or if you've already claimed and are managing other income sources, calculate your provisional income, your adjusted gross income, plus tax-exempt interest, plus 50% of your Social Security benefit. Compare that number against the thresholds for your filing status. The checklist. Calculate your provisional income using the formula above. Compare against the $25,000 to $34,000 threshold for single filers, or the $32,000 to $44,000 threshold for married filers. Model provisional income under different Social Security claiming ages. Identify which income sources you can time or shift to manage the calculation. Consider Roth withdrawals as a lever in years close to a threshold. The Social Security tax torpedo isn't a rare edge case. It's the default outcome for a large share of retirees with any income beyond Social Security alone, and it's been sitting there, unindexed, since the 1980s and 1990s. If this helped, subscribe. Next up, why up to 85% of your benefit gets taxed, and the provisional income trap explained in full detail. I'm May. See you in the next one.